A couple weeks ago, New York Times article came out. Trump only paid $750 in income taxes. Oh my God. But does that make him corrupt or smart? Because people like to use the word tax loophole. No, it's a tax law. And if you're not utilizing all the tax laws that you can to make sure you pay your fair share, I don't know what to tell you. But what that story actually does is it kind of exposes, I don't want to say expose, that's a negative word. It shows the benefits of commercial real estate ownership in building wealth and how you can lower your taxable income from things like cost segregation, depreciation, mortgage interest deductions, tax credits, historic tax credits, conservation easement tax credits. There's all sorts of stuff. So if you don't know all the benefits of real estate ownership, how they lower their taxable income and therefore increase your cash flow, give me a call. But let's go through this article, which covers some of the things that Trump has done over the years to lower his taxable income and what you may be able to do as a real estate owner or investor to realize some of the same benefits. So here we go. Trump tax saga shines spotlight on benefits of CRE ownership. It may seem like a lifetime ago, but before news of the ongoing COVID-19 outbreak involving President Trump, White House staffers, Republican politicians, and others, the New York Times stirred up a political firestorm surrounding the president's Trump tax saga shines spotlight on benefits of CRE ownership. It may seem like a lifetime ago, but before news of the ongoing COVID-19 outbreak involving President Trump, White House staffers, Republican politicians, and others, the New York Times stirred a political firestorm surrounding President Trump's personal finances with a new investigation revealing a staggering amount of business losses over the past 2 decades. The headline grabber was that he paid just $750 in federal income taxes in 2016 and 2017, and nothing in 11 of the 18 previous years. Additionally, the article said he claimed a total of $1.4 billion in losses from his core businesses for 2008 and 2009 and collected a $72.9 million refund for the 2010 tax year. The article is just another chapter in the ongoing saga of President Trump's personal tax returns, which he has chosen not to release to the public, blah, blah, blah. Let's get to the interesting stuff here. So here we go. President Trump said said publicly that he has paid millions in taxes, including property taxes and payroll taxes. At the same time, he's also candid admitting he's utilized tax credits, deductions, and real estate depreciation to offset income. For example, the Trump organization received $40 million in federal historic tax credits for its 2014 $200 million renovation of the old post office in D.C., just blocks from the White House into the 272-room Trump International Hotel on Pennsylvania Avenue. The ability for commercial real estate owners to substantially reduce or even fully negate their federal income taxes is not unusual. The reality is that investors frequently use operating expenses, mortgage interest deductions, and depreciation to offset rental income, as well as applying tax credits to further lower tax obligations. As a simple example, an office building collects $500,000 in annual rental income. On the deduction side of the ledger, the owner can claim $300,000 mortgage interest deduction for leverage on the property, $250,000 in depreciation, and $150,000 in operating expenses. In this case, the taxpayer recognized a $200,000 operating loss for the year for tax purposes, even though they had a positive cash flow of $250,000 from the depreciation. So you're not paying any taxes. Now, you have to do that later when you sell the property. There's a tax on cost recovery or depreciation, just like capital gains, but you can roll those into a 1031 exchange. There's opportunity zones. There's other interesting stuff. The tax code's a very complex set of rules, and there are court cases that could fill up a building with all the paperwork, said Thomas O'Rourke, D. O'Rourke, a partner at Haskell & White LLP, a public accounting and advisory firm based in Irvine, California. However, when you break it down to a very simple approach to a real estate investor who could have massive amounts of depreciation and leverage, that is the real estate dream. Tax deferred consequences with current cash flow. And then when you die, there's a step up in the tax basis of the value when assets transfer to heirs. I'll read another article on basis. I have one from before, but basis determines how much capital gains you pay. And so what they're talking about here is when you transfer property to your heirs, there's a step up in the basis. So if you bought it for 100,000 30 years ago and now it's worth $1 million, when you transfer it to them, it's going to be worth $1 million. So they're not going to have to pay capital gains on $900,000. So let's see, commercial real estate investors who use deductions to offset taxable income is a common practice. My focus is primarily on privately held real estate companies, their owners, and families that own them, and it is standard practice to have a structure that provides these benefits. A home builder or house flipper doesn't have the same tax advantages. They are viewed as a dealer, but real estate investors who are invested in private partnerships or structures do get a lot of flexibility to get allocations that are tax beneficial, he says. It's not cheating, it's just the law. So what he's talking about there as a dealer, yes, home builders, that's active income, passive income is what we're talking about here. So when you own a piece of real estate and you're collecting rental income, that's seen as passive income, which has a lot of different rules associated with taxation. So making the most of deductions. Taking advantage of tax code to reduce or avoid taxes is certainly not a strategy unique to President Trump. However, CRE does offer opportunities for some unique tax breaks. Owning commercial real estate is one of the greatest vehicles to not only build wealth, but also to shelter it from taxes with things such as depreciation, cost segregation, mortgage deductibility, 1031 exchanges, and opportunity zones. There's a ton of completely legal ways a commercial real estate owner can make money in commercial real estate while still showing a tax loss. Tax legislation following the Great Recession created some additional tax breaks for investors who suffers losses during the downturn. One of the spigots that opened in 2010 was that provisions regarding net operating losses extended the carryback on losses from 2 years to 5 years. It was that was likely the change that opened the door for President Trump to claim additional tax losses that contributed to his securing a multi-million-dollar refund in 2010. However, the refund also meant that Trump had to pay a significant amount of taxes at some point in order to be able to claim that level of refund. So what's really interesting about that is, so let's say you had losses of $100,000 in 2 years ago and $50,000 the year before, you can use those losses to offset your gains today. So that's really, really powerful. Another thing about passive income is that you're able to take losses and carry them forward. So carrying back and carrying forward. So talk to your accountant, and sometimes it makes sense to go ahead and refile your taxes from previous years if something like this may be applicable. The Tax Cuts and Jobs Act, which took effect in 2018, eliminated what had been a 20-year limit on the ability to carry losses forward unlimited in use each year. In other words, taxpayer could continue carrying accrued losses forward indefinitely. However, losses created after tax reforms went into effect on January 1st, 2018, were limited to 80% of taxable income in any given year. So basically what they're saying is, you can only carry forward 80%. However, the CARES Act passed earlier this year suspended the 80% limit on taxable income limit on loss carry forwards for 3 years, and also allows taxpayers to carry back losses from 2018, 2019, and 2020 for 5 years. Very, very powerful stuff, and great for real estate owners now who are just getting hammered from the lockdowns, the pandemic. Tenants aren't paying rent, so this is actually really a good thing. Landlords are small business owners as well. Another tax provision that President Trump has utilized in the past to reap millions of dollars in write-offs is conservation easements. In a conservation easement, a property owner gives up the right to make certain changes to a property in order to preserve it for future generations. For example, Trump reportedly secured a $21.1 million charitable tax deduction for signing a land conservancy agreement in 2015 on the Trump Organization's 200-acre Seven Springs estate in Westchester County. He also has a conservancy agreement at his Mar-a-Lago resort in Palm Beach. However, this is one deduction that may not fly in the future. That has become a very hot button issue with the IRS, and there are some very substantial law firms and appraisal firms that are on the hot seat about their opinions in conservation easement cases. So talking about the value of that property and what she can write off, which makes sense. I sit on the Board of Equalization for Fairfax County, and utilizing the county's determination may be a way to justify it. An independent appraisal could do it too, but obviously you want to be as generous as possible within the legal limits of the law. Debt write-offs generate tax savings. He has referenced the audit as a reason for not disclosing his tax records. The New York Times article sparked curiosity from people who would like to see more detail on President Trump's itemized business expenses especially after reading about $70,000 write-offs for haircuts. Yep. One group digging into those details is the IRS, and it's no secret that President Trump's been in the midst of a decade-long audit. The picture the New York Times investigation paints is a man who never pays his taxes because of all the big losses, creates a public impression that the real estate is sometime a big tax shelter scam, and that's not the case. President Trump has a team of very capable tax attorneys and advisors who rendered opinions that the tax provisions he utilized should withstand IRS scrutiny. President Trump doesn't do his own taxes, okay? The other thing to keep in mind is that we are looking at anecdotal news reports on what, as tax attorneys, we know to be very complex tax provisions, particularly in the edges, blah, blah, blah. Let's see. Unfortunately, another part of the picture, it's impossible to discern without further documentation, is assessing how much President Trump's income and offsets has come from real estate as opposed to other forms of income, blah, blah, blah. So according to Phillips, another concern is not the reported tax losses so much as it's President Trump's history of not repaying large amounts of debt. Is it possible to shelter tax income for years on end? The answer is that there's no way to do that if you want to earn a real economic profit. But there is a way to do it if you're fortunate enough to borrow money, utilize that money for tax deductible expenditures, and then never pay it back. For example, the $1 billion in losses that the New York Times reported on during the last presidential election was due in part to Trump's use of tax law provisions regarding S corporations that allowed him to use tax basis for debt, even though he never had to pay the debt back or recognize income from that debt when forgiven or discharged, says Phillips. The tax provision was eliminated in 2002, and now a taxpayer would have to reduce the amount of net operating losses by the amount of forgiven debt. Again, you're just utilizing what the tax law allows. For those that share the view that debt is perhaps a bigger issue than the amount of taxes President Trump pays, his current loan obligations could be concerning. According to the Times, President Trump has $420 million in loans and other debts outstanding, with most of it coming due within 4 years. Okay, what happens then is you refinance. The issue with refinancing depends on how much equity you have in it, and any sort of losses caused by the pandemic. So if you bought a property for $1 million, 5-year term on a loan, and you got to refinance in 5, but now it's only worth $900,000. Well, you better hope you got at least $100,000 in equity. So yeah, that's pretty much it. Invest in real estate, especially now. It's a great idea because we just passed a $6 trillion stimulus, which is really just a tax through inflation. It's going to devalue our money. So the $100 you have in the bank now may be worth 80 in 10 years. If you buy a property for $1 million now and, at the same level, I mean, it's not the exact, but let's say same inflation, so I'm just use 20%. Well, you're going to sell the property for $1,200,000 in 10 years instead of, losing value on your money. Properties are bought and sold with the dollars at the time. So real estate acts as a great hedge against inflation. So if you have any questions, want to chat more, I'm happy to do so. Any real estate investment opportunities that you'd like to discuss with me, you can reach me at ryan@realmarkets.com or 703-943-7079. Have a great day.